Everybody, welcome. We are here today for CHU's February webinar. Today we're discussing driving sustainability in insurance and strata management, and we have the wonderful Fraser Gow presenting for us. So just a little bit about Fraser for those of you who don't already know him. So Fraser Gow is a dynamic leader at CHU Underwriting Agencies. He is renowned for driving impactful change and innovation. Since joining as a customer service team leader in 2020, Fraser has excelled, advancing to dual roles as head of customer service and head of direct portfolio. Fraser has been instrumental in championing CHU's ESG initiatives, leading the team that earned the 2024 ANZIIF Excellence in Environmental, Social and Governance Change Award. What a great night that was. His visionary approach has driven the development of new strategic initiatives and innovative solutions to tackle complex industry-wide challenges, reinforcing CHU's commitment to accessibility, sustainability and customer-focused solutions. With an MBA in Executive Leadership completed in 2022, Fraser applies key learnings from the program to enhance decision-making within his roles and in strategic development, ensuring CHU leads the way in positive change and remains in the forefront of the industry. So that is a little bit about our presenter today, Fraser Gow.
Is that about me, Pauline?
That was all about you, Fraser.
Did someone fact check that? That sounded too good to be true. Did you write that?
That just shows how wonderful you are. I could have added a lot to that, but in the essence of time, we won't. We'll continue on. So now just our acknowledgement of country. In the spirit of reconciliation, CHU acknowledges the traditional custodians of the land on which we live and work throughout Australia and their continuing connection to land, sea and community. We pay our respects to the elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples. So thank you today for everybody who has joined us in the call. Please feel free to pop any questions into the chat. We will go through these throughout the presentation, so I'm quite happy to take questions as we're going. And Fraser, over to you.
Thanks, Pauline. It's a privilege to be here. And thank you for donating an hour of your time to me. I really appreciate that. When I was putting the content together for this webinar, it was really important to me that I wasn't just outlining CHU's progress and initiatives, which I'm sure you all care about, but that I was providing some specific actionable steps that you can take back to your businesses to either implement for the first time or to extend your existing ESG strategy. So I really hope that you get a lot out of the next hour. And as Pauline mentioned, if you have any questions that you wanted to ask me that we can answer, please pop them in the chat and we'll see if we can answer them at the end. So the agenda, what's on today? What do we want to do? I'll give an overview of what ESG is. It's a term that's flung around a lot, and sometimes the meaning and purpose can get a bit lost. So we'll start with just defining what ESG means, what it is. So I'll also give you a look back at the steps we've taken over the last 2 years since we rebooted our sustainability journey and how that, as Pauline said, culminated in CHU winning the ANZIIF Excellence in Environmental, Social and Governance Change Award last year. I'll be discussing what it means to assess materiality. You'll hear that word a few times today, and I'll describe what that is and how it relates to how you would craft ESG goals and strategies. And then I'll be giving some tools and resources to you so that you can take or start your progress to your business's ESG journey after today. So what is ESG? Here's a wordy definition for you, which I will read out. ESG is a framework that measures how a company operates in relation to the environment and society. It's a way to evaluate a company's non-financial risks and opportunities and how well it manages them. That sounds good, but what is it? I just want to clear up a big misconception straight away. ESG, or sustainability in general, isn't just about the environment. A lot of people hear sustainability and they think, oh yeah, we recycle at our office, so we're good. We're good with that. And look, that's great, but ESG is bigger than that. At its core, ESG is a strategy. It's a strategy that shapes how businesses operate and stay relevant. It's a strategy for how you treat your people. It's a strategy for managing risk and building trust through governance. It's a strategy for ethical and responsible products and services. So at the end of the day, it's about resilience. It's about making sure your business is prepared for the future. What does it look like though? What might it look like? For example, I'll put this in terms of if you're operating another business. If you're a retail business, what might your ESG goals and pillars and targets be? In the environmental space, you might want to cut down on packaging waste. You might want to offer a carbon neutral delivery option. In your social pillar, what might your target be? Maybe you want to source from ethical suppliers. Maybe you want to improve working conditions in your supply chains. And in the G, in the governance space, your target might be to publish those ESG targets transparently because accountability builds trust. One more example I can give is if you're a bank, your ESG commitments. Maybe your environmental pillar is aligned to aligning your investment portfolio with net zero commitments. In your social space, maybe you want to support financial education or inclusion in underserved communities. And your governance pillar might involve building a diverse leadership team and holding them accountable. So you can really apply those ESG concepts in every sort of industry. And what I want you to think about today is how we can bring that back to our industry, Strata. What role can insurance brokers and strata managers play in supporting sustainable and responsible communities? What challenges might you face when bringing ESG into your advice or your property management strategies? And how do we measure the success of those ESG initiatives in Strata? Have a think about those as we go through this presentation. Why would we do it? A lot of people have this question to me, like, it's a lot of effort. Why would we go through the effort of putting an ESG program in place and putting all that time and resources into it when you're not going to get anything back? It's not going to be profit for your business necessarily. Why would we do it? There's a few reasons. Firstly, risk reduction. So let's be real, like when people think, or when businesses focus on risk, it's mostly financial risk that they're thinking of. But ESG kind of lets you zoom out and see a bigger picture. So we're talking about risk that can kind of sneak up on you. Climate issues, supply chain disruptions, changes in regulation. If you catch these early, you can avoid costly mistakes and you can kind of stay ahead of the game. That red card, sustainability, not just ethical, it's strategic. In a lot of industries, ours included, businesses can struggle to differentiate themselves. So whenever everyone offers similar products and services in an industry, how can you find that USP? ESG can do that. Builds trust, attracts customers, enhances your reputation. We've also seen it play a critical role internally. So ESG-driven companies tend to have higher employee engagement, stronger workplace culture, lower turnover rates. So it's easier to attract and retain top talent. Lastly, that regulatory thing on the green card, the regulatory landscape, it's changing. You might know this or you might not, but as of last month, if your business has more than 100 employees or over $50 million in annual revenue, you'll need to start climate reporting as of now. So that likely applies to about 30% of you in the audience today. The good news is that you can start building that ESG framework now, and it's not hugely time consuming. What's not on these cards is customer expectation, which is actually also quite important. I forget the stat, I think it's 70% of consumers prefer brands with strong ESG commitments. And businesses are prioritizing ESG-focused suppliers in their supply chains and their procurement decisions. It used to be, and I'm thinking 5 years back, ESG was like this thing that's nice to have, not any longer. It's more of a requirement these days. If you want to stay ahead of the market, ESG should be a core part of your strategy. Now, I'll just touch on that regulatory landscape thing in a little bit more detail. So for those people that are required to make that climate disclosure as of last month, what does that look like? What might that look like? And I'll give an example as a strata management firm. Now, before I start with this, I might just define what I'm going to talk about when I refer to scope. Scope 1, Scope 2, and Scope 3. Scope 1 emissions are direct emissions your company makes via things that they own and control. So this would be things like fleet vehicle emissions. If you operate a factory, it's the emissions that that factory would output. Scope 2 emissions are indirect emissions from purchased electricity, so your office site. And Scope 3 emissions are emissions from your supply chain or your company's value chain. Does that make sense? I can't see any of you, but I imagine you're all nodding along, which is great. Now, what might that disclosure look like if you're a strata manager, a strata management firm? You've got to disclose your Scope 1 and 2 emissions. This is easy. Your fleet vehicle emissions in tons of carbon dioxide and your office energy consumption in kilowatt hours. Easy done. You've got to refer to your Scope 3 exposure. Now, this is quite important. I know that this question is going to come up, but I'll answer it now and get ahead of the game. Would strata managers be responsible for declaring the carbon emissions of the buildings under their management? The answer is no, which is really important. However, they should disclose whether and how they engage in sustainability initiatives for the buildings that they manage. That's things like advising bodies corporate on energy efficiency, resilience, climate risk adaptation. You should discuss Scope 3 exposure qualitatively, that's a difficult word, particularly with how climate change might affect your business operations moving forward and the risks associated with managing properties. What else do you need to do? Undergo a risk assessment. And this is climate-related risk. And what we can do is break this down into physical risks, which might be extreme weather, floods, bushfires, drought, what the impact would be on that. Maybe there's an increased workload as there's claims that you might need to manage. Maybe there's emergency response, putting pressure on resources that you might own and control. Financial risks you'd need to assess. The rising costs of materials, the rising costs of labor and insurance. What's the impact there? Is the budget pressures on OCs leading to delays in maintenance or disputes? Is that a risk to your business? And then you've got operational risks. So this would be business disruptions due to climate events. What's the impact there? Maybe you have contractor shortages in your supply chain. Is there a higher administrative burden? Is there a stronger demand for ESG commitments from your business? Again, qualitatively explain that exposure in terms of financial risk, regulatory pressures, and operational pressures. Lastly, governance and strategy. This is really simple. Governance. Who is responsible for managing those risks at an exec level? Strategy is what actions the company's taking to mitigate and adapt to those risks. That's pretty much what your climate disclosure looks like. Just to recap, you don't need to report actual building emissions from the buildings under your management, but you should acknowledge climate risks relating to your management role. You must disclose Scope 1 and 2 emissions. You should disclose Scope 3 emissions, but qualitatively, particularly with how climate change might affect your business operations. And you can then enhance your disclosure by engaging with sustainability initiatives and showcasing your role in how you would support resilience.
Fraser, just to interrupt you, we did have a question come in.
Sure.
So I think this might have actually been a couple of slides back. We've had one question from From Ben, is an employee in Strata an owner?
Can you explain what you mean?
Yeah, I'm not sure what context you mean that in there, Ben. We'll wait and
We'll move on, but if you can clarify, I'll be happy to answer.
we'll wait and see if Ben gives us a bit more information.
So off the back of that disclosure requirement, I just wanted to talk about what ESG trends we're seeing globally in insurance. Now, it's no secret that Australia is well behind the eight ball when it comes to environmental, social governance commitments. There's a number of reasons for this, be they legislative or cultural, but what are we seeing globally, particularly in Europe when it comes to ESG, and are these likely to come to Australia? Get my slide to move. Sustainable underwriting. This is a big one. What we're going to see is a transition, and I'll mention these words a few times in this presentation, but it's a transition from screening, which is avoiding the negative impacts, to steering. So we want to avoid negative, and we want to move from avoiding the negative parts of a risk to steering, which is driving positive impacts in our portfolio. So where I see a sustainable underwriting approach in Strata going is involving two streams. So one of these streams would be resilience, incentivizing stronger, lower risk properties. So this is actually soon to be a factor. If we've got any Queensland strata managers or brokers here in the audience, you'll know that when you insure a cyclone-prone risk in far north Queensland, the ARPC Cyclone Reinsurance Pool has implemented a question set, which insurers use to understand whether they're mitigating loss in the event of a catastrophic weather event. So specifically involving wind-driven rain and wind load. If properties can prove that they've done specific things to mitigate that loss or to make their properties more resilient, their insurance policies actually get discounted, which is a big step in Australia. Are insurers currently doing that with other things? No. Insurers are still avoiding bad risk instead of what we should be doing, which is incentivizing resilience. So what insurers do is we start from a clean risk, 100% score, and basically load that from there based on the negative risk in aspects. What we call that is screening. This will change. Insurers will shift to a steering activity to lower risk and, in effect, incentivize sustainable properties. Does that make sense? On the other road, so we have resilience here, which is great because we're lowering our own risk, we're lowering premiums, thus incentivizing people to become more resilient, which is fantastic. On the other avenue, we've got environmentally and sustainable and circular communities. So the industry is exploring how to balance this with financial risk. We want communities to be sustainable and circular, but it has no impact in our risk and the cost of that risk. So in time, that could mean adjusting premiums based on a building's sustainability credentials. More sustainable properties and businesses could receive discounted premiums, while those on the other end of the scale, those businesses or buildings contributing to environmental risk, may face higher costs for their long-term insurability. And what we see here is a balancing. So we're discounting on one end for sustainability, and we're loading on one end for businesses that aren't great for the environment. And what we see is a gradual shift in our portfolio to a more sustainable overall view, which hopefully, when we define metrics for that, will be provable. It's quite complex. It requires standardized sustainability metrics, really great transparency and risk assessment to achieve this. And sometimes there's a disconnect. So EVs and EV chargers are a great example of this. EVs aren't reducing our risk as an insurer. In fact, they're more risky for a building to have, simply because there's more electrical infrastructure, there's risks with maintenance, there's safety, there's more liability, there's theft. So what the disconnect is here is that we want to, as an insurer, be incentivize that sustainability. But if it costs us more from a risk perspective to offer that, what are we doing? What are we doing about that? What strategies can we put in place to stop that and put an end to that disconnect? So this is where the industry is heading. It's not just about ethics, it's about reducing risk, long-term portfolio stability. And I think as those trends kind of come to light over the next decade, insurers will need to adapt those pricing models and those incentives to reflect a more resilient and sustainable future for Strata. Climate resilient insurance products. So one of the biggest shifts that's happening is the move from reactive to proactive products. If you haven't already heard from my previous slide, this is kind of where it's headed. So for decades, for as long as I can remember, insurance has been reactive. We assess the risk, we price the policy, and then we pay out when a loss occurs. But with climate change increasing frequency and severity of claims, this approach is becoming less sustainable. Instead, what we're seeing overseas, Europe and America specifically, is insurers moving towards proactively reducing that risk before it happens. So rewarding resilience rather than just absorbing that cost to claim. What that will involve is a collaboration with customers to mitigate that risk. Insurers won't just underwrite the risk. We'll actually play an active role in preventing that risk from happening in the first place. So that means working with lot owners, developers, strata managers to identify where those vulnerabilities are and encourage resilient building measures. Now, by actively steering, and I use that word again, steering customers towards climate adaptation strategies, we as an insurer can reduce our overall cost of claims, not just for individual policies, but for an entire portfolio or an entire industry. For example, if a large portion of strata properties are built or upgraded to withstand flood or bushfires, the number of catastrophic claims we receive decreases. And this will benefit everyone. This is customers experiencing fewer disruptions to their day-to-day lives. This is insurers maintaining portfolio stability, and this is communities becoming more resilient over time. So this is key. This is key. Imagine an insurer that could approach their capital provider and say, hey, QBE, along with our loss ratios, here are the quantitative metrics for how sustainable our portfolio is over time. Wow. Could you imagine how pleased they'd be to see that provable data about long-term risk reduction? It is incredible how powerful these metrics will be. And this shift's already happening overseas. Over the next 10 to 15 years, I reckon we'll see this approach become the norm rather than the exception in Australia. So just as a takeaway here, I'll reiterate, insurance isn't just about paying claims, it's moving towards helping prevent them by being proactive. So the insurance industry going through a massive shift as well with data and tech and that buzzword AI. So we're moving beyond the traditional way of assessing risk where you look at past claims and you try and guess what might happen next. Now, AI, yes, AI, real-time data and predictive modeling are kind of changing the game a little bit here. I mentioned predictive modeling. So one of the biggest areas we're seeing is how insurers predict climate-related risk specifically. Instead of just looking at historical data, AI models are now pulling in real-time weather patterns, satellite imagery, geospatial analytics to predict those disasters before they happen. For example, some insurers in the US and Europe are using AI-powered wildfire risk models to try and determine which properties are most vulnerable. And they don't look at where fires have happened before. Those models look at vegetation growth, wind patterns, local emergency response times, and they forecast where the next big risk will be. What's the goal here? Again, it's to move from being reactive to proactive. So instead of just paying claims after disasters happen, insurers can actually help customers reduce that risk before an event actually occurs. That's the definition of sustainability. With Chew Inspect, I don't know if you've heard of our business Chew Inspect, but we acquired a business now known as Chew Inspect. And if you're unaware of what they do, they offer virtual internal and external building inspections. What does that let us do? It identifies structural risk in properties before they become claims. It assesses vulnerabilities to extreme weather and catastrophes like floods and storms. It provides that critical data to the body's corporate, the owner's corporations, as well as assessors and trades to assess damage without having to visit the site. And it provides better risk insights to our underwriting team to make sure that policies reflect the actual conditions that the buildings are in. So what we'll see is a move from a kind of a one-size-fits-all approach and more towards a sustainability-focused model that benefits everyone, benefits the insurer and benefits the customer. Am I going too fast, Pauline? You think my pace is good?
I think your pace is absolutely fabulous, Fraser.
It's
You're
funny.
doing well. You're doing
I
well.
know that there's 1,000 people in the audience, but I can only see you, so it's kind of just like I'm talking to you right now. You like what I'm saying, don't you? Good.
What? Look, I love listening to you, Fraser, especially on this subject. So please go ahead. Oh, look, we've got a thumbs up there. Somebody else likes what you're saying too. That's great.
Now, I'll just briefly go through where we've gone. I mentioned that that we reinvigorated our sustainability initiative 2 years ago. I'll give a run through of what we've done over that time, which did lead to that Excellence Award from ANZIIF last year. Wasn't that long ago, July 2023. Materiality, I've mentioned that word at the start. Materiality is basically about figuring out what actually matters when it comes to ESG. So not all sustainability issues are equally important to every business. So materiality helps cut through the noise and focus on the factors that have the biggest impact to on your company and to your stakeholders. This is quite important. You can't just guess what your sustainability targets could be. You need to ask the people that are living in the communities in which you operate. So we undertook a materiality assessment. With that, we wrote our first sustainability charter. So we used the responses and the priorities that our stakeholders identified to create targets and strategies around each of the E, S, and G sections. Targets were then linked to SDGs, the UN Sustainable Development Goals, and we promised to update the market annually on our progress. And we did so. Later that year, we released our first impact report. So what this document does is it updates the market on our progress towards the commitments that we made in our charter. We also made sure to report in line with the Global Reporting Initiative standards, just to make sure that we're giving an objective view of our activities and it's not a puff piece. So the main purpose behind this report is to update the market. So sometimes we achieve the targets we set out, sometimes we don't. But regardless of the outcome, we make sure to report on that progress for all our ESG initiatives without that fluff, just to ensure transparency to market. We undertook a panel review last year. It's a big thing being on CHU's National Building Panel, isn't it, Pauline? It's a big deal. So
it is, and we spent quite a bit of time doing this one.
It was it took a good 6 months, but we had a $300 million spend on claims rectification last year, and the majority of that goes through 40 builders nationally. So luckily, that puts us in quite an enviable position of being able to select those builders based on quite competitive metrics, which include quality, customer feedback, price, and sustainability commitments. So we could actually pick our builders based on their commitment to our sustainability journey, which is fantastic. Very, very powerful. Later this year, we hope to have our claims and underwriting sustainability strategy set, and that'll likely go in the underwriting space in those two channels: resilience, eco-sustainability, and neutralizing our claims supply chain emissions. So I wanted to go through a case study with you. I mentioned that we had a $300 million claims expense, rectification expense last year. We're going to talk specifically about the E in ESG and relating to planet-related things at the moment. But we had a lofty goal of becoming the first insurer in Australia to fully neutralise all supply chain emissions. And when we first said it, we thought, okay, that's going to be not so hard. But then it came to light that that's actually incredibly difficult due to the nature of the supply chains that insurers have. Now, I wanted to outline the emissions output during these activities, and I'll outline what opportunities or roadblocks we might face in trying to neutralise them, just to give you a bit of an idea here. Waste. So of that total rectification emissions output, only 1% was attributed to waste disposal. We had about 450 tonnes of CO2 generated from waste disposal. Energy use, that was next. So we had 15% of our overall emissions were due to claims rectification energy use. That was 6,000 tonnes of CO2 a year. Now, interestingly enough, 50% of the carbon emissions emitted during our claims rectification was from transportation. Now, tradespeople represented 15,000 tonnes of CO2 of that, and site assessors represented 6,000 tonnes of carbon dioxide emissions. Huge. And lastly was material use. So of the total emissions from our claims rectification process, 34% of emissions were put down to embodied emissions from materials. And when I say embodied emissions from raw materials are the emissions output to get that raw material out of the ground and into the product that you then use in your building. So the questions that we had were, well, how do we identify, reduce, and neutralize the emissions created by activities, and where could we make the biggest impact? So you'll remember from the slides, transport, 50% of our emissions. What can we do to prevent the need from trades to attend site multiple times to provide quotes? And when we think materials, how can we embrace circularity in our claims process to prevent the need from virgin materials being used? What can we introduce, or who can we partner with to ensure that we have a way to repurpose waste effectively? What are our challenges here? Well, the information that we get from builders, most of the time we get a price and we get a scope of works. We don't have information on materials, energy use, transportation, and waste. It's not what they provide to us. How can we change that? Interestingly, the builders on our panel do about 10% of the work themselves, and they subcontract the rest out. And sometimes those subcontractors have subcontractors. How do you control your supply chain effectively so that we can have data all the way through from the lowest subcontractor all the way through to us as the insurer? And lastly, the data that we have on our buildings is quite substantial. We've got 40 years worth of data on almost every single building in Australia and its construction. But that's limited. We have the construction details, but we have no data around sustainability, livability, environment. How can we change that? Where do our opportunities lie? We can set a code of conduct to align expectations with our builders. With underwriting sustainability, how can we come up with standardized metrics to assess sustainability in our insurance portfolio? And how do we set those finer expectations with our builders, specifically with 4 buckets: waste management, energy use, fleet vehicle emissions, and material use? And how do we get that data transmitted to us quickly and easily? So I want to just talk about how a business measures its impact. We understand what we do with maybe crafting a strategy. We've talked slightly about materiality, but how do we measure the targets? How do we even come up with targets? You might have seen these before. UN Sustainable Development Goals. They're basically a blueprint to achieving a more sustainable future. And the goals cover 3 dimensions of sustainable development globally. They are environmental protection, social inclusion, and economic growth. Now, you might See a pattern there. Environmental protection, social inclusion, economic growth. What does that sound like to you? They sound like environment, social, and governance. It's quite similar. And you can actually group those in terms of your ESG, just so that you have an even split of focuses throughout your strategy. And what makes it even easier to do is to split those SDGs into 4 Ps. You might see it on the slide on your screen at the moment. You've got people-related SDGs, planet, prosperity, and partnerships. Here are the people SDGs. Now, for insurance brokers, I'll try and give this to you in the context of your industry, but for brokers and strata managers, it could mean engaging with clients ethically, or ensuring that their services meet the needs of diverse communities. It could be that ensuring buildings under your management support safe, accessible, and healthy living conditions for residents. Or it could be encouraging policies that promote mental health support and employee well-being. Prosperity-based SDGs. So in the, planet, when I say for prosperity, planet-based SDGs. In the insurance and strata industries, this might translate to encouraging those sustainable building practices, or offering coverage options that incentivize environmental responsibility, just like we talked about in the steering section of the webinar. Prosperity. This is driving economic growth. So for brokers and strata managers, to give you a bit of context, this could mean helping clients make choices that aren't just financially sound, but also align with broader sustainability goals. Or it could be encouraging fair wages, safe working conditions for trades and service providers. Or it could be advocating for resilient, future-proof upgrades for infrastructure in strata communities. Last but not least, we've got partnerships. There's only one. He's a bit lonely there, but it kind of ticks all the boxes when it comes to partnerships. In insurance and strata, this could be collaborating with local councils on climate adaptation initiatives, like flood mitigation strategies, green infrastructure, or it could be engaging strata communities to educate residents on eco-friendly practices. So they can be, these SDGs, they can be grouped into 4 main areas to ensure that you've got an even focus. As the slide says here, sometimes 17 goals are just too much to bite off in one bit. So a few at a time actually makes a bigger impact. How do you decide which ones to focus on? Let's come back to materiality. Materiality, the process of defining what's most important. How do you tell a community what's most important without listening to them? Here are the steps involved that you would take. Firstly, you define what your scope and purpose is. Before you ask everyone, how do you devise what those questions are that you ask them that will give them an accurate idea of what you need to focus on in your strategy? Phase 2 is gather. Gather information. This is where you survey your stakeholders, your employees, your suppliers, and your customers. From that information, you'd prioritize some really key identified material topics, and then you'd use them to create goals and set your strategy from there. And afterwards, you'd engage with management and follow up with your stakeholders to show them that you're delivering on what they've identified as priority. Now, you might have seen in the invitation that you got for your webinar that there was a link to a sustainability survey. Thank you for those that completed it. It's quite interesting. What this will give you is an idea of where you sit from a sustainability perspective and what you've identified as the most important things that you need to focus on in your business. Gives you a little benchmark score of where you sit. And if you haven't completed it, I'd really encourage you to do so. There's a little QR code on your screen here. If you scan it, it'll bring you to the CHU toolkit where you can fill in that information and generate that scorecard for yourself and your business. Now, not only does this toolkit provide those areas and strategies for you, it actually feeds that data back to me. So remember when I said that materiality was based on input from employees, suppliers, and customers? Well, guess which one you are? That's right, customers. So that data that you provide will not only be helpful to you, but it feeds back to me and allows me to tweak CHU's ESG strategy based on the importance that you place on sustainability measures in your own communities, businesses, and environment. So I would really encourage you to complete that survey when you get a chance. And I promise you that the data that you provide to me will be used in the creation and crafting of our own ESG strategy. This is
And
what
thank you. Sorry, Fraser. Thank you, Zoe. You might all notice that Zoe's also put in the chat there a link to it, just in case you didn't get the QR code down.
Thanks, Pauline. Thank you. Thanks, Zoe. So this is what it also gives you. It's got two columns here. Gives you what you're doing well at. And this is broken down into individual SDG. And the second column is what you should probably work on. So you could create a strategy from these SDGs. What that looks like is totally up to you though. But as long as you're taking input from your stakeholders to craft that strategy, that's what's most important here. That is materiality in a nutshell. To recap, ESG needs to be ingrained in overall business strategy. This is quite important. There's no use having a standalone team responsible for setting strategy if the exec team's not bought in. ESG needs to be a lens through which overall business strategy is set. Conduct materiality. Understand the areas that stakeholders identify as important. Makes sense. Step 3, select SDGs to focus on that align with those areas, group them into 4 Ps to make life easier and understandable. Lastly, craft targets and strategies with alignment in those focus areas. That's pretty simple. It's a really simple 4-step process. And I just wanted to pass this information on to you in case you're wondering where to begin, where to even start with creating an ESG strategy and how actually easy it is to do so. So what can we do together? How can we create positive change in our communities? More specifically. Does everyone like my slideshow transitions? Pauline, do you like my transitions?
Oh, Fraser, you are the best at transitioning.
Thank you. I put a lot of effort into those transitions. I'm glad.
Oh, look at the response you're getting from everyone.
Thank you all. So what can we do? We can promote sustainable policies. So creating positive change in these communities in which we operate, it's not just about making buildings greener. It's about working together to make them more resilient and to make them future-proof. So strata managers, insurers, owners, brokers all play a role in this. And I think that by working together, we can create policies that benefit everyone. So where does this partnership have the biggest impact? So I think in your sphere of influence, especially the strata managers in the audience, you probably agree that one of the biggest barriers to sustainability is regulations and approvals. We've seen cases where owners want to install solar, rainwater tanks, EV chargers, but outdated bylaws make the process too complicated or expensive. So what we want to do in future, we cannot do this right now, but what we want to do in future is help strata managers and brokers understand which sustainability upgrades may reduce future risk and align that with insurance considerations. What if we could come to a broker, come to a strata manager and say, just a heads up, we can reduce your premium by 20% in the next 10 years if you had electric EV charging on site or solar panel or rainwater tank. What if we could do that? Now, strata managers can also work with us to create bylaws that kind of support that long-term resilience, whether that's approvals for solar, water efficiency upgrades, climate smart materials. I think it's important to remember, whoops, and I moved forward too much. I think it's important to remember as well that we're not working in silos here, in strata managers, brokers, and insurance. We rely on each other to foster sustainable communities. We can't do it by ourselves. The more that we're aligned and on the same page here with policies, data, decision-making, I think the better positioned our communities will be for the future. encouraging green investment. I know there's going to be a ton of questions about EV and EV charging too. EV and EV charging is an obvious one, but it doesn't come without challenges. Infrastructure costs are huge. Governance challenges are hard to get by. But things are moving in the right direction. I think it's the National Construction Code was recently updated to mandate all Class 2 buildings, so apartment buildings with more than 2 or more solar occupancy units should now accommodate EV charging. So it's coming. It'd be a great opportunity to conduct a resident survey to get a feel on what Lotto attitudes are. Is it a priority? How can you engage an energy audit maybe to obtain a building energy assessment? How can you facilitate sustainable transitions? Interestingly, so EVs and EV chargers currently don't form a part of our question set. So insureds are not under any obligation to inform us, and thus it has no impact on premium. This may change though, as I've said, as insurers kind of adapt to a more electric ecosystem. But our position, again, screening versus steering, would be that we'd probably look to incentivize green additions as we look to make our overall portfolio provably more sustainable, despite them potentially carrying a higher risk. With solar, for example, explore options such as government grants. I know in Victoria, there's a $140,000 government grant available for solar installation for strata buildings, something to consider. Virtual inspections. I mentioned to inspect, but this is quite an interesting one. 50% of our emissions output by claims rectification were from site assessors and from tradespeople visiting site. What you get, and with a desktop report and a virtual walkthrough of a strata building, is quite impressive through to inspect. Costs a few $100s, and that sits on file. It's owned by the body corporate. What you can do in the event of a claimable situation or an emergency is upload photos to specific points on that walkthrough map. You can send that report to loss adjusters and tradespeople. They can actually quote up repairs without actually having to visit the site at all. And that's aside from having the other benefits like resilience, identifying structural issues, and things along those lines as well. So I'd really encourage you to look into to inspect and look into the virtual inspection option. So when we talk about resilience planning, we're talking about future-proofing a building. We're making sure that strata properties are prepared for what's coming next. So this could be weather, rising energy costs, resource scarcity. And this is the key point. Sustainability and risk management go hand in hand. A sustainable building isn't just good for the environment. It's more resilient, it's more cost effective. And in the future, it's going to be better positioned for insurance considerations. Sustainability will have an impact on insurance ratings in future. I promise you, it is coming. So a lot of sustainability initiatives do actually double as risk mitigation strategies as well. So they don't just help the environment, they also make buildings safer, more cost efficient. Where do we go from here? As I've said, sustainability measures currently don't impact insurance premiums, but I'd be very surprised if that was the case in 5 to 10 years. At CHU, at least, we want to have an active role in supporting that resilience. So as we refine the data and the metrics, we want to be able to identify high-risk areas as they change, which would help strata managers and brokers prioritize things that would make the biggest impact. And we want to use our claims data to map risk patterns, whether that be flooding, storm damage, fire risk, and connect that information with sustainability initiatives. This is where the industry's headed. And I think by working together now, all of us, we can help shape a future where sustainability and resilience are fully aligned. That almost brings me to the end of my presentation here. I mentioned some tools and resources that you can give, and I'd be happy to send this presentation to anyone that might like it. SDG Align, my friend Will, I think, is in the audience. He helped us with the toolkit helped us with the materiality. He was really a driving force behind the SDGs that we focused on and how we made that happen. They're a fantastic business. That toolkit is free to use. That CHU branded toolkit is free to use. If you have any other questions, please reach out to them. There's a great webinar about the ESG reporting commitments that CPA Australia did. There's some information about the SDG Compass, how to align your strategies and measures to manage your contributions. Australian government's put out a really great sustainability checklist as well. If you're starting your ESG journey and don't know really where to start, this is a great checklist to try and just try it out. GRI Academy, they're the ones that set the Global Reporting Initiative standards. It's just a beginner's guide to that. And of course, our holy grail, what we follow, the climate change roadmap from the ICA. Thank you. That brings me to the end. I just want to say as well, one of the things that I'm proud of, and this isn't just me, this is our entire team, is the way that we worked at this strategy one step at a time. You know, sometimes you need to say, where can we advance the ball down the field each and every time? And you don't score a try every time, but you move the ball forward. If you score a try every time, then your goals probably aren't high enough. But how do you set the right benchmarks so that you know that you're making progress and you're moving in the right direction? Have a think about those questions. Good luck with your ESG journeys yourselves. Thank you for your time today. I'll be happy to answer any questions you might have if we still have some time, Pauline.
Yes, well, oh, sorry, I'm going light and dark over here. Sorry about that. That is my environmentally friendly lights in the office. So yeah, look, we have had a couple of questions that have come through and we have a couple of minutes. So just to address a few of them. Now, Naylene, you did mention about contractor quotes being challenged by owners as it is, and if we are including environmentally sustainable products into quotes, is that going to then blow out costs and therefore increase premiums? I think, Fraser, you answered this already and probably very well by talking about the future of what we're looking at with quoting. Would you agree that, you know, like our products are going to, you know, reflect that we can, you know, provide discounts in the future for corporations to, you know, to jump on the bandwagon? So there's ways that, you know, our corporations are going to be able to save money.
Yeah, really good question. Thank you. It's not our objective at all to raise premiums. By doing so, we would have the opposite effect. We would be steering people away from using environmentally safe materials. So any cost involved with substituting eco-friendly materials would be a cost that the insurer, I think, would wear. And of course, I'm speaking hypothetically, big picture right now. What we realized as well, Naylene, is that you might be familiar with the upside down R's in a pyramid. What can make the biggest impact to the environment when we talk about materials? You know, the reduce, reuse, recycle, that kind of thing. At the top of the pyramid is actually not using those materials at all. What makes the biggest difference to the environment? Not using any materials. And then you've got recycling, reusing, repurposing after that. And then at the very bottom, it's just disposing. So what we realized, and this led us to the resilience piece, is that the biggest effect that we can have on the environment is by not using anything. And that sounds great as an insurer, right? I don't want to spend any money on claims. That's not it at all. It's about reducing our risk by making these buildings more resilient and incentivizing that movement to making them more resilient so that we don't have to use any materials at all. And what we do use, we try and use in a kind way to the environment. Did that answer that question? That
was a perfect answer, Fraser. Love that.
Thank you.
That was fantastic. I think we've probably got time for a couple more quick ones. We did have a question about the cyclone reinsurance pool in Queensland, and that's changing to assist with building resilience and affordability with premiums. And how does CHU think that will change the future of quoting? I can actually direct you all onto our website now. There is an update that was posted yesterday for those of you who may not have received an email. There is going to be some changes when it comes to the pool and how we're quoting and discounts that can be provided. So if that affects you, please jump onto the website and have a look. One more quick one, Fraser. How does CHU's ESG roadmap align with the broader industry trends and government policies?
Good question. Really great question. Did you write that yourself, Pauline?
I actually didn't write that. No.
What we've tried to follow is the ICA's roadmap. But like I said, in Australia, we're quite far behind the 8 ball when it comes to those aspects of ESG. Now, where we've gotten to is that Australia is so far behind ESG commitments, the rest of the world, that we've had to introduce mandatory reporting disclosures. Would we have gotten to the same place without that if it was more of an organic industry-led approach? Maybe. But in saying that, the fact that we have to disclose these reporting disclosures means that businesses are now mandated to improve their footprint. And as a result, industries are following suit and they're setting their own regulations. Now, are those regulations good enough? Are those timeframes good enough? Maybe. ICA, for example, has a target of 2030 for insurers to be Scope 1 and 2 carbon neutral. CHU's been there since 2018. And they've got a target of 2050 to be fully supply chain carbon neutral. And we hope to be there by 2035. So while, yes, industry is leading the direction, I think that the moves that insurers are making, especially, are too small. If you consider banking, the banking industry, the Big Four have sustainability reports available in which they are accurately able to prove the sustainability of their portfolio. And they've been steering their portfolios for the last 10 years. Why haven't insurers do this? Yes, insurers have excuses. Their supply chains are huge. And I don't expect you to take this with a grain of salt, but we've got a big supply chain of 40 builders, which have subcontractors and subcontractors. You think of an insurer like AIG or QBE, how massive must their supply chains be? And with that size comes difficulty to control and for data to be transmitted. So yes, there is a good roadmap from the industry put in place. Is it good enough? Not sure. What we want to do is lead the way and try and do the best we can to show other insurers in the industry that it's possible.
Thank you very much, Fraser. That was also a great answer. And thank you to everybody for joining us. Sorry we couldn't get to all of the questions. We will see if we can answer some more offline. But have a great rest of the day, everyone, and stay tuned for the next instalment in CHU's Environment Sustainability Journey.
Thanks, guys.